Pokemon Go creator brings in 76,000 US dollars. Sounds pretty good, right? But how much of that is actually theirs after business expenses, self-employment tax, income tax, health insurance, and retirement? By the end of this video, we're taking one hypothetical trainer from $76,000 of gross revenue all the way to an estimated 2026 federal tax bill. And I'll show you why deductions don't always mean something was free. I'm Kyle Johnson, a CPA, Pokemon Go competitor, and gym leader at Lavender Accounting. We're here to help Pokemon creators and competitors know what they'll owe so April is never a surprise. First off, this is not the average Pokemon Go creator. Public tools can estimate views, memberships, subscriber counts, but they cannot see someone's complete books. So we're using a composite example. It's a realistic case, not a claim against any specific creator's income. Our trainer earns money from several parts of the ecosystem. Maybe they publish YouTube videos, stream, run a Patreon, accept sponsorships, compete at events. One possible revenue mix could look like this. We've got YouTube ads and memberships at $35,000, Patreon at another $15,000, Twitch streaming, tips, and donations at $10,000, sponsorships and affiliates $8,000, tournament winnings $8,000, for a total of $76,000. Different platforms may send different tax forms. Some may send no tax forms at all. The form doesn't create the income. If you earned it, the income is generally taxable. Before deducting anything, we need to ask whether this activity is a business or a hobby. You do not become a business just by opening an LLC, and you do not get to choose business treatment simply because the deductions are better. The IRS looks at facts and circumstances. Are you operating in a business-like way, keeping accurate records, spending meaningful time on the business, trying to improve your profitability, depending on income, making a profit in some years? No single factor decides the answer. For this example, we'll assume our trainer has a real profit motive and operates as a sole proprietor or a single member LLC that is disregarded for federal tax purposes. Either way, the activity generally lands on Schedule C, and net profits usually flow into the self-employment tax calculation. Got questions, business versus hobby? Check out the video above. We did a whole video discussing the topic in depth with numerous of examples. All right, now we separate gross revenue from business profit. A deductible expense must be ordinary and necessary for the business. It also has to be documented, and a mix of personal and business costs must be allocated. All right, here's one. Let's give our trainer $10,000 a qualifying event and travel costs. That cost could include airfare, lodging, rideshare, registration fees, and any business portion of a rental car. Business meals are generally only 50% deductible, and if the trip were mainly personal, adding one video or a meeting doesn't magically convert the whole vacation to a business trip. For a personal vehicle, the 2026 standard mileage rate split is 72.5 cents per business mile from January through June. Starting in July all the way through the end of the year, it's 76 cents per mile. That makes a dated mileage log especially important this year. Next, let's assume $5,000 for phones, cameras, microphones, tripods, battery packs. You can deduct or depreciate only the business use portion, and the timing depends on whether the asset and the tax rules apply. And then we'll throw in another $6,000 for editing software, graphics, contractors, and creator tools, plus another $1,500 for the business share of your phone and internet. This gives us total expenses of $22,500 for our example. That amount of $53,500 is the key number. It is business profit. It is not the final taxable income, and it's definitely not the take-home pay. If you found this video helpful so far, do us a favor over here at Lavender Accounting. Hit subscribe, like the video, and comment below with where your Pokemon income comes from. All right, trainer, we've knocked out gross income. We've knocked out expenses. Now, self-employment tax enters the battlefield. Employees split Social Security and Medicare taxes with an employer. A sole proprietor or an owner of a single member LLC generally covers both sides of the self-employment tax. The rate is 15.3%, but generally it only applies to 92.35% of the net self-employment earnings. In our example, 92.35% of $53,500 is about $49,407. We multiply that number by 15.3, and the estimated self-employment tax for our example is $7,559. You generally get an income adjustment for about half the tax, which in this case is $3,780. But that deduction does not erase half the tax. The full $7,559 is still a part of your federal tax bill. Next, let's assume the trainer pays $5,000 for qualifying health insurance premiums. A self-employed person may be able to deduct the eligible amount, but there are limits, unfortunately. One of those limits involves whether the person was eligible for subsidized employer coverage. Marketplace premium tax credits can also make the calculation more complicated. This deduction is not considered a Schedule C expense. It generally appears as an adjustment to income, which is why our Schedule C income is still $53,500. Now, for retirement, for somebody under 50, in the year 2026, the IRA contribution limit is $7,500. We'll assume $7,500 traditional IRA contribution is fully deductible. That is different from the SEP IRA, which uses a separate contribution calculation and has a max of $72,000 for the 2026 contributions. Your actual SEP limitation does depend on your earnings though. Here's the income tax ladder. Start with $53,500 of business profit. Subtract about $3,780, half of your self-employment tax, another $5,000 for health insurance, and $7,500 for your traditional IRA contribution. In our example, our estimated adjusted gross income is $37,220. The 2026 standard deduction for a single filer is $16,100. That takes us down to roughly $21,120 before the qualified business income deduction. Eligible sole proprietors may also receive a qualified business income deduction, usually called QBI. It can be up to 20%, but it does have limitations like everything else. In this example, the taxable income limit holds the QBI deduction to about $4,224. That leaves our estimated total taxable income at $16,896. Using the 2026 single filer brackets, estimated federal income tax is about $1,780. Notice what we did not do. We did not multiply every deduction by 22%. The trainer is largely in the 12% bracket, and the QBI interaction changes that savings again. All right, let's get everything on the screen. So we've got gross receipts at $76,000, everything collected before cost. Our Schedule C expenses are about $22,500. This is anything ordinary and necessary for the business. That means our Schedule C net profit is $53,500. This is our starting point for the self-employment tax calculation. On the self-employment tax, we're looking at $7,559, and that is our Social Security and Medicare tax. Our federal income tax is $1,780. This is after all of our adjustments. That means our total all-in federal tax on our gross receipts of $76,000 is $9,339. In this simplified case, the estimated federal tax bill is about $9,339. That is roughly 12.3% of the gross receipts. Do not, though, use 12.3% as your personal set-aside rate. If you add another job, a spouse, a kid, capital gains, marketplace subsidies, state taxes, that answer can change quickly. After the $22,500 of business costs, $5,000 of health insurance, $7,500 of retirement, and roughly $9,339 of federal tax, there's about $31,661 remaining for other personal expenses. But remember, the IRA contribution does not disappear. It moves $7,500 into your trainer's future. And the deductions mattered. Under these same simplified assumptions, removing $22,500 of business expenses would raise the combined federal tax bill by roughly $5,200. A deduction saves a part of a dollar, but not the whole dollar you spent. The big lesson is simple. Revenue, profit, income tax, and take-home cash are 4 different numbers. If you only watch the deposits hitting your account, taxes can feel like a surprise final boss. Track every income stream, keep receipts, mileage records, separate business and personal activities, and revisit your estimates during the year. Do not wait until April to look at it for the first time. And if you're earning money from Pokémon as a creator, competitor, or card seller, subscribe for more tax guidance built for this community. If you want help running through the numbers or doing the calculations, visit us at lavendertownaccounting.com. There, you can get in contact with us through our Contact Us form, and we can explore options that work for you as a trainer. Until next time, keep training, keep good records, and keep Team Rocket out of your tax return. Oh, and if you want to see some of our other videos, we might have one here, we might have one here, or I don't know. We'll see where they pop up.